Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy any investment based solely on the companies we mention. Please do your own research.
Hello and welcome to Monday Upbeat Markets with me, Graeme Dickson.
Me, Kevin Hornsby.
And me, Charles Archer.
And we're going to be talking to our very special guest, Charles Archer, and discussing the 12 stocks of Christmas. It's an absolute pleasure to have you, not just as a guest, but soon to be a co-host of our podcast. How do you feel about that, Charles?
I feel very happy. You know, I think the small cap space is going to go ballistic over the next few years. A lot of the capital in the blue chips is going to start trickling down, and we're well placed to see that rise and rise and rise.
So pleased as an investor and as a sort of advisor to a number of investors, I'm very pleased to hear that, particularly in the small cap space. Now, you've got a lot of followers, Charles, but for those that don't know who you are, could you tell us about where you're from and what you did before you ventured into the world of investing?
Yeah, sure. How far back do you want to go, Graham?
Post-university onwards, should we say?
Post-university. Oh,
I want to know why your parents did it.
Very good, Kev. Yeah. So basically, I went to the University of Exeter after a decent old stint at boarding school. Really enjoyed it. Lovely. Met my wife down here and then didn't leave. And then when I graduated, there were pretty much no jobs, as there aren't from time to time. And you know, this is sort of like just post global financial crisis time. And I imagine a lot of graduates, if anyone's listening now, probably feeling the similar sort of way. So I did what anybody does when there's no jobs after you come out of university. I did a PGCE and was a history teacher for a year. And I cannot describe how much I did not enjoy that at secondary level. But you know, it's funny because when you do a few jobs before you settle into what you really want to do, you build up that skill set, right? That you can't really learn from anywhere else. And if you can, you know, talk about William the Conqueror in front of, 35 bored 11-year-olds, you can do a podcast with a CEO, no problem. So yeah, PGCE, didn't enjoy teaching, and like many teachers, work-life balance primarily, left very quickly. And then I went into recruitment, initially with a large recruiter and then self-employed for a few years. Anyone who's been in recruiting will know it's pretty brutal. You can make a fairly decent amount of money, but you're going to be working 50, 60-hour weeks. But what recruiting did for me is it built a pretty strong financial network where I started to know. It's kind of funny, like you go to London the first time as a young man, it feels like a very big city. But the more and more you learn about it, the more you realize there's not that many people controlling everything. And it's the same in the small cap space, right? It's the same sort of 30, 40 people funding all of the placings. It's the same couple hundred people who are non-execs on the boards of pretty much everything. Once you get to know everyone, you get to know everybody. And I really did enjoy recruiting, right? But two things stopped me. The first was I got tired, was the first. And the second was the arrival of my first child, Ace, who is 12 and now 13 and at grammar school. And yeah, I mean, time flies super, super quickly, as you'll know. So one thing about it, I couldn't do those long hours anymore. Just couldn't cope with it, especially with a child coming along. And then the second was on the way, and I thought, right, I can't do this anymore. What am I good at?
You were commuting from Exeter to London, were you?
No. I was in Exeter pretty much all of the time. I mean, occasionally I would commute in. I mean, it is quite interesting, Graham, because the fast train from St. David's and Exeter to Paddington is still only 2 hours.
That is fast.
And so you feel like you're really far away. As long as it only stops in Taunton, Bristol, Swindon, Reading, Paddington. Yeah. 2 hours and you're there, and then obviously the Elizabeth line is right there. So often there are people.
If you were to drive up, Charles, how long would it take?
Probably, a lot longer, 3.5. Yeah. Because you're escaping all the traffic. But I find it quite funny because there's plenty of people who want to have that physical feeling of living much closer, and yet their commute is probably not that much shorter than mine is, should I need to go into the city. Which is kind of mad to me. I mean, I think a lot of people realize this now, actually, because during the pandemic, a lot of people went for remote work or mostly remote work or hybrid work. A lot of people moved down to the southwest. Then when the pandemic ended and people started being recalled back to work 1 or 2 days a week, they realized they didn't have to move back. You can just, it's really not that bad if you're doing it once or twice a week. But anyway, yeah, so I've, I cast my eyes around, what am I good at? What do I want to do? And I thought, I'll do a master's degree in law. So I did that with the University of Law for a year, which was quite exhausting. And also at the time didn't have particularly much money either. So, children trying to do a degree full time. But also if you have any kind of money, it's very difficult to get any kind of funding. But, did that sort of almost a decade ago now. And then came out of law. I did a vacation scheme at a Magic Circle firm, and I won't name them, but it's quite easy to find out if you want to. And what I realized very quickly is that it's not all fun and games. I thought it'd be quite fun, but it's actually not. It's just a lot of paperwork. And probably the thing that it's probably was a bit naive of me, but then I was fairly young. Is you want to do a little bit of everything, and you want it to just be enjoyable. And what actually it turns out is that you tend to just hyper focus on one specific aspect of law and do the same thing over and over and over again. And I've got friends who went on to work at that Magic Circle firm and various others who are making loads of money, but they'd never say it, but they're very bored. And I can't be a bored person. I can't do it. So
no.
Fairly quickly realized law wasn't for me. I was like, okay, well, my wife at this point was starting to get irritated because she said, you try to become a teacher and you are a teacher, but you don't enjoy that. And I sort of, you wanted to become a lawyer, but you don't want to do that either. And you did recruitment for a while, but you didn't want to do that. I was like, okay, fine. I'll find something else to do, but it'll make me a bit of money. And fortunately, there was a small family office that I had recruited for in the past, and one of their junior analysts was leaving. I was, had that master's degree. I had that recruitment experience. I knew the world. I got brought on as a very, very junior analyst and worked there for a year or two, or just almost 2 years. At which point,
what year are we talking now?
That's going to be back in 2017, 2016.
Okay,
so just about 10 years ago.
Yeah.
And then once they basically as tends to happen in family offices, they didn't make any. Do you know what? Even though it was a long time ago, I did basically they didn't make any good succession planning, and I'll leave it at that. So.
Right.
I went and worked with AJAX, where I've been since 2019, 2020. So initially as a writer, but then now as an analyst and also a site editor. So I do a significant amount of work for them. And as people there's probably most people listening here will know, IG is one of the probably the most popular broker platform for retail investors looking at small caps. And Graham, I know that we host you there occasionally as well.
Yes.
To listen to your insights. And IG, I've loved working there for years and years. Throughout various rotations of people, because the culture there is fantastic.
Yeah.
And then last year, in the summer last year, I took on a part-time role at crypto.com in the United States as a senior market analyst, which is quite a fun time to join the cryptocurrency world because obviously Bitcoin went to the moon and then came back down again. At the same time, because I just enjoyed small caps since 2020, 2021, so this was shortly after leaving that family office, and around the time I was starting at IG, I started writing small cap analysis. And it wasn't to generate any revenue or to make any money. It was because I spotted two trends. I saw that a hell of a lot of money was being printed during the pandemic. And all that money being printed was being handed to people who had nothing to do at home. So we could see at IG, tons of new platforms exploding into the popular consciousness. Most of them have been consolidated or died off now, but loads and loads of people started trading, started investing. And one of the problems / opportunities is when people start investing or trading and they don't have any education in it, they often go for small caps because they go for the highest risk, highest reward positions. And then obviously, if you will remember during the pandemic, all of the small caps just went ballistic. Pandemic ended, they dropped off. We had a couple of really bad years, and that was the point at which I started to position for myself, because I thought, some went wrong. I'm not going to pretend like I'm an oracle of Omar. Like some things did go wrong, but the ones that did go right, like Guardian Metal Resources, for example, or Greatland, after they signed that deal for Telfer, you made an extraordinary amount of money for doing the research.
Yeah.
And that's basically, my history. Then, I worked with various, services, freelance, in the small cap space. I started appearing podcasts, ditched a few websites that I'd been working on and started a Substack because I felt that sort of email outreach was powerful. Started a Telegram group, I want to say a couple of years ago, got 1,000 investors in there, which is, a decent group of people. Comes with its own set of problems because everybody in the small cap world has an opinion. Yeah. And the loudest people often think their opinions are most important. And this is basically where I am now, where I kind of split my time between working with IG, working with Crypto.com, ghostwriting a fair few articles and pieces at kind of a higher level of finance, where my name's not attached. But if you know my writing style, you'd probably be able to identify it. Yeah. And loving the small cap world, basically. Yeah, that's where we are.
It's really it's really nice to see someone with such a sort of broad experience in your career that you've ended up focusing on the small caps, whereas some would have just chosen perhaps large caps with leverage, perhaps because they like the liquidity, they like the safety that it's a big company, and what big companies go bust, you all know they do, but
a few of them, yeah.
but that you've not gone for the mid caps, you've not gone for the large caps, you've gone for the small cap end of the market. What is it about the small caps that appeals to you so much?
So one thing, the way I set up my own portfolio, and this is not investment advice or financial advice or caveat after caveat, there's basically two ways to invest, right? There's active and passive. And passive investing, anyone here listening will know, but it's worth going over it. You're picking some index funds, maybe a bit of gold or silver, maybe some platinum, maybe some real estate through real estate investment trusts. They're very low expenses. You might find in a year you lose money, but over the course of a decade, it's very hard to lose any capital, right? And so, for example, if you're invested in the S&P 500, and then the 2008 global financial crisis happened, you only had 5 quarters of recession, and then the growth started again. So if you're going to go down the investing route, then there's passive investing, and then the alternative is active investing, right? Which is what fund managers, charge for. Often fund managers underperform. And I realized early in my career that actually the number one thing that you need to beat passive investing, to beat the index funds, to generate more revenue, is access to management on a personal one-to-one level. And so often that means, is it realistic? And, am I going to be able to get one-to-one conversations with the CEOs at Tesco and Rolls-Royce and Tesla? Is Elon Musk going to answer my call? Probably not. In the future, maybe, hopefully, but right now, no. If I send a message to Sean Day at Greatland Resources a few years ago before it went ballistic, or even now, he'll probably send a message back. If it's a micro cap and the market cap is under sort of 10, 20, 30 million, and you're someone in the space who wants to understand the investment case and present that story, they have all the time in the world for you, right? And this is, for me, is the key thing, because often the companies that we tend to focus on down here, the ones in junior resource, so mining, or life sciences, so biotech, right? If you're able to have generally the things that matter is, do they have a decent capital position, as in do they have money? Do they have a decent asset, as in is there copper in the ground, or is their phase 3 trial going to be successful, or whatever it might be? But the most important thing is management, because the same management teams tend to deliver, positively or negatively, time and time again. And one of the big differences is the ability to talk to management about your concerns or about the positives and have them answer them. And often, I'm not sure about you, Graham, but sometimes there'll be a company I've researched and on the surface it looks fantastic and they've got a great asset and they've got loads of money and everything is going great. And then you talk to management and you just get that feeling, that gut feeling that something's not quite right.
Yeah.
And then I don't then burn the bridges there, but I just don't invest in it. I don't write about it. I don't cover it. But sometimes you'll talk to management and you just think, wow, this is a person who is going to go after it and get it. And if it fails, it's not because of management. It's because, something goes wrong, as things do. But, and And a good example of that is Oliver Friesen, right, at Greatland,
Yes.
or Ippolito at AJAX, or Elder at Amarok. You just have 2-minute conversation with those guys, and you just think, yes, this is someone who believes in what they're doing, has the confidence, has the energy, and then I would say where it becomes super valuable is bringing those conversations public facing in interviews in a way that almost nobody else does, and that's what we're doing today.
No, very good. And it's interesting about those characters you were talking about. Elder from Amarok. I mean, he had some previous experience and success, whereas I think Ippolito and Oliver from Guardian Metals and from AJAX Resources, they're kind of relatively unknowns that not had much background because they're still extremely young in their industry. It's only when you talk to them that you realise that the level of knowledge that they have about their industry and their passion that makes you're one step closer to that point where this is enough for me to push me over the edge to make that investment.
Yeah, 100%. And I think the one of the things I liked and continue to like about all of them is that they're clear-eyed about the risk and they're honest about the risks, right?
Yes, yeah.
When you're putting money in, like with Guardian, we're probably sitting at a 40x from IPO levels and even more from pre-IPO. But there was no point at which any of them said, things can and do go wrong in the space, and it tends to be the ones that acknowledge the risks up front are the ones that deliver the best returns, ironically, and the ones that promise the moon are often the ones that crash to zero a week or two later.
Charles, there's some empirical evidence that says that the difference between where the actual share price is and the price target by an analyst is usually the opposite happens, and then
yes,
you know what I mean? Where there's a close target price to the actual share price, they tend to outperform the ones that have the biggest share price.
I find the share prices that the broker, and I've written a few broker notes, some under my name and some ghostwritten, right? And I obviously, to an extent, you're FCA regulated when you write them, so you have to be careful about what you write, and they're all within a framework. But I find the price targets often on them to be so maybe ridiculous isn't the right word, but the way that they're written, the way they're constructed, is just makes no sense, right? So, for example, Pharma or SVNS, right? You're companies that I like both companies. They've got great assets. I think they're going to do extraordinarily well. If SVNS, for example, is in phase 3 clinical trials, right? A broker note will say, right, we're going to give a target price based on the chance of success that these phase 3 clinical trials are going to succeed. But it's nonsense, because if the phase 3 clinical trials do succeed and they get a major on board, then it will obliterate that target price and just go massive. And if it doesn't succeed, it will never hit that target. But that target in the middle makes no sense at all. It should either be the target if it fails or if it succeeds.
Yeah.
Not some, this kind of weird. And it's the same with Avacta, and it's the same with various other biotechs in the space. But also in
with the biotechs particularly.
Yeah, well, Virginia Resources is not exactly the same, but it is similar in that you say you go for an exploratory drilling campaign, right? And you're looking for sort of a high grade copper, tin, gold, whatever asset. Oil drilling might be a better example, actually. How many of us, and I've been invested in loads of it, you invest in an oil drill, right? And it's one drill, and if they hit, then you're going to have a multiple return. But if it fails, it's a duster, and that's life. Broker targets, again, they do exactly the same thing, which is, and you'll know this, Graham, where you say, right, what's our chance of success in this drill? Okay, we've decided it's 1 in 4. If it's successful, then the share price will be £1. So we're going to apply that 1 in 4 chance, and 25p is our price target. It's just nonsense.
Yeah.
But having said that I would say the price targets are usually worth ignoring, but the research that a lot of the brokers do is excellent. And I think that's probably another thing, reason why my articles do so well, because A, don't have the FCA regulations kind of like breathing down you so you can actually say what you think. True. And B, a lot of the broker notes are actually quite difficult for retail to access, which I find quite funny because the brokers complain that there's not enough liquidity and people aren't buying, but then they restrict access to the research that would make people buy or not, which is
a good point. Actually, one question that's just popped into my head is, given that you've had some great wins, obviously, with Greatland Resources, as it's now known, Guardian Metals. I'm sure there's a whole host of other companies we could mention here. But because of the way you write, does this kind of help you personally to sort of remind yourself about the reasons why you've actually invested in this company, so that you don't sell out too early? Or
yeah, so yeah, no, I know what you're kind of getting at. I think
someone gives you a stop tip. Yeah, it says, Kevin says, go and buy Kendrick. As opposed to you doing the research on it. Does it make a difference to you, to the way you do your whole thing?
I think there's a few things. I think that I'm trying to think of the words. The first thing is portfolio construction, right? So there are stocks where, I term them core portfolio stocks, where I think the rewards are decent, and you might 3 or 4x what your initial position is over a few years. Your chances of going to zero are very low. There's growth stocks where there's a bit of cash in the bank, and they might, for example, have a resource defined, right? Or they might be in a phase 3 clinical trial and a lot of the risk has been removed. And then there's kind of like moonshots where you might do 100x return, but you could also lose all of your money. And I think the key thing is to make sure that your portfolio is constructed in such a way that you have the capital allocated to each company within where it should be. So, and the key, obviously, if you've got £1 million to invest, then you can put 10 grand into a moonshot, and if it goes to zero, it's not going to affect you particularly much. If you've got 100 grand to invest and you put 10 grand in a moonshot and it goes to zero, that's probably going to hurt a little bit.
Yeah.
But I think one of the key problems is that psychologically in the small cap space, people kind of, they remember their wins and they forget their losses quite often. I try to keep myself honest. I mean, on my Substack, I track month to month where we are up, right, and what we're doing. So last year, the portfolio as a whole, it rose over 100% in 2025, which obviously is fantastic. I don't expect to repeat that, by the way, being honest. But within that portfolio, a couple of positions fell 50%. This year, we're up 25% year to date, but there's 2 or 3 which are significantly down. I think they'll recover. But I think the key thing is that if you're going to invest in the small cap world, then it's asymmetric returns. You're going to have some positions that do extraordinarily well that make up for the losses. And I think the big thing is, if your winners are winning, you have to let them run. And conversely, if you invested in a stock at what you believed was a reasonable market cap, and then the market cap is halved, but the investment case is still the same, the management is still the same, the capital position is still the same, that's not a reason to sell. It might be a reason to, average down. I think that a lot of people don't trust in their own research, or alternatively haven't done any research at all. And that's where you run into problems in this space. Basically, you need to be able to say, for the amount of money that I've put into this particular company, am I happy to hold it for the next 5 years, no matter what happens? Sometimes things do come along. A CEO leaves, company does like a deeply discounted raise that you weren't expecting. You go do exploratory drilling and you find out all you have is dirt. There are reasons to sell, and we've all been there. But if the fundamental investment case hasn't changed and you didn't overinvest, then you're fine. And I think for me, I've said this many times, there's 2 things I find quite funny. I ran a Twitter poll a couple of years ago, and I probably should rerun one on Substack now. And it was something like 45% of 1,000 responders were only invested in one stock. Wow. So, yeah, mad. But the other thing is the 7 a.m. test, right? So this is really simple. It's really, really easy. If you're waking up at 6:59 a.m. and checking the RNS feed of a specific company for a piece of news that you're hoping for, you are almost always overinvested. Right?
Okay, that's interesting.
It's as simple as that. Because if you have a portfolio of like 10 or 15, then you're fine. If you're waking up at 7:15 and checking, then that's fine. But it's that preempting for news that you're hoping to get. That's the sort of thing. It generally tells you you've put too much money in that particular company.
Yeah.
But
I've got a question. I've got a question for you, Charles. Just in terms of this investing and when to invest and when not to invest. I think we've gone through a 3-year period, maybe longer, of a bear market. Okay, and I'm not sure investors have switched to bull market in terms of resource plays, because everybody's still looking backwards as if to say, well, there's going to be this discounted placing and there's going to be this and there's going to be that. So do you think that there is an argument that we should be more risk on at these times and obviously less risk on when we realize that it's a bear market?
Yeah, I mean, the old Warren Buffett saying, right? Buy when others are fearful, which, potentially is not applying to the small cap world. I would say probably on the bull market side, one of the key points is that, and I'm not blaming the brokers particularly, because they're also have been operating in a very difficult market, but they effectively had a monopoly on the financialization of small caps for a couple of years there. So nobody wanted to lend money in a personal capacity. Funds didn't particularly want to invest. It was difficult to get any money out of the US. You're now seeing scenarios where small cap companies are being approached to be financed. That could be by state actors, for example, or by high net worth investors, by family offices, by funds, by US capital. In some cases, for example, resource companies are starting their own trading arms, to fund their corporate expenses. And so the brokers, while incredibly important still, they have to offer, I think, slightly better terms than what they did in the past. And I think the other thing is that if you invested in a placing, for example, 2 or 3 years ago, in a resource company, for example, you probably lost money over the past 2 or 3 years. But a lot of those stocks that you put in your bottom drawer and forgot about, they're now even. They're coming back up, or they're rising again. And it's also the case, this is my personal belief, that if you invested in, some of the IPOs that we've had over the past few years, the Delta Gold you mentioned, or if you were, or Guardian Metals is another good example, or if you put money into placings in resource stocks, you're actually making money. The whole model was always meant to be a company IPOs with, say, 5 million in capital. They deploy that 5 million, the market cap rises above it, and then when they next place shares, it's at a higher price than the IPO price, and then again and again and again. And we're back to that now. We are, in many cases, back to that, where those placings will be at a premium to the last one every time. Whereas the past 2 years, 2023, 2024, often what happened is the placing was always at a lower price, so there was no reason to take part in it. And yeah, I do think, though, that just generically, it's kind of, I do a lot of work with the ASX, not with the ASX, with Australian listed companies on the ASX. And the way they do things seems to make a hell of a lot more sense than what we do in London. For example, if you want to do a placing, you have to suspend the stock, announce the placing. You then offer it to current investors first before it goes to anybody else. And then you reopen the stock. Why do we not do that in the UK? It makes no sense.
We should do that here. And it also gets rid of market abuse.
Yeah.
As well. So I think many people would agree with that.
Yeah. Well, I think, there's a lot of things that the Australians do that we should do and don't. And it's kind of funny because, the AIM market has fallen and fallen and fallen in terms of listings. But I think it's fairly expensive to be listed in London now, right? You're looking at, realistically, once you take into account lawyer fees and listing fees and nomads and salaries, 500,000 to $1 million a year is pretty normal nowadays. If you're not listed and you put that 500 grand into growing the company as a private company, are you better off? If you don't have any liquidity, then generally yes. And that's basically, it needs to be the case that AIM provides you with more positives than the cost of being listed. And I think now we're getting back to that point.
And there's competition now with Aquis.
Yeah.
Aquis is actually starting to come into its own, which I think has been lacking over the last 2 or 3 years. AIM and the standard list, as it was then known, have kind of had a monopoly. Now, there's some competition for vendors.
Yeah, and Aquis is significantly cheaper, and I think they're lighter touch as well, which I think I think it's this weird kind of thing, right, where the private companies that we all work with can say whatever they want to their investors about what's going on because it's privately listed. You can't really offload the shares, If you're publicly listed, you're very restricted in what you can say. And it's often the case, for example, that, like I've known deals that are being negotiated for sort of where I've been inside, for several months at a time, and you can't say anything, and they can't say anything, and a deal was being negotiated, and if people knew, then the share price would be a lot stronger. But because there's no news, it just falls and falls and falls. I think that it's kind of interesting because a lot of the rules that AIM says are in place, it doesn't seem to me like they're followed at all. And we had Priority AI, which Kev will remember, where and I don't particularly want to get sued, but so I'm not going to name the parties, but there was a lock-in agreement that was simply ignored, and there were letters went into AIM, but letters went into LSEG, VSE, and just nothing. So you're the other thing for me with AIM is that if you're going to have regulation, it should be enforced. Alternatively, weaken the regulation significantly and get everyone on the same playing field, so the information is available to all. But this kind of halfway house where some people have the information and use it and others don't, and there's no punishment if you do use it, it's just a disaster. And it seems to be where we are now. For example, when a placing is coming for the vast majority of stocks, if you were to do data analysis of it, I'd say at least 80% of AIM stocks see a share price fall before a placing announcement. That means that the rules are not being followed one way or another, which is partly why people don't invest. It's not just the risk; it's also the sense of fairness that you just don't have. Whereas if you invest in an index fund, you just feel like it's fairly risk free.
Well, that's why they should do what the Australians do, and you get rid of all this skullduggery that happens.
Yeah, but it's also the spreads are I feel like I'm on a big whinge. I'm not trying to be, but the spreads are another huge problem, right? Because you invest in a small cap with a 20% spread, you buy and you're straight away you're 20% down.
Yeah.
And then because the spread is so high, you've got to wait not only to get that 20% back up, but then even higher to break even. If you're going to make a market, you need to make a market at a very reasonable spread. If you do it like that, then just nobody will trade it, which is just mad. But I don't know. There's probably reasons for all these things.
It's interesting you say about the spreads. I know brokers out there that will tell their clients not to invest in any market maker led stocks. They only want SETS QM, I think it's called.
Yeah.
Hybrid of between market makers and SETS, where you can actually electronically put your limits and your quantity that you want to buy or sell at, which would then put you at sort of the same advantage as, in theory, an institution.
Yeah, I don't know. I think the thing is, though, is that if you don't invest in these small caps, you are missing a trick, because there is the opportunity, and I think particularly if you're young, right, and you don't have many responsibilities, say, if you put 10 grand into a stock that does do a 30-40x return in an ISA, then you've bought a house outright, and that's life-changing. You're not going to do that with index funds. And I think to an extent, and this is not financial advice, but if you are, younger, the deck is stacked against you, and you do need to take some risks in order to get out up in front. And there are going to be there are opportunities now, and there will be opportunities in the future, where if you invest across a small basket of equities, if only one of them does extraordinarily well, then you're going to be sitting back extremely happy. And the flip side of that as well, obviously, is that if it does do extraordinarily well, often there's a huge amount of liquidity backing it, so you're able to get out of that position. The negatives of the private companies, I talked about the positives, is that, okay, wow, you might think, wow, I've got 400 grand of shares in this company, but they've just decided those shares are worth that much. They're not actually worth anything until you sell them, and you might find, oh no, now we've got a 70% haircut if we want to actually offload them to somebody else. So being on a public market, you actually do have a share price that is what somebody is willing to pay for it. And I think often that does create a significant amount more of honesty, because it's very easy, for example, in the resource space or in biotech, the stuff, all the tech companies that we follow, for people to say, oh, my company should be worth sort of like 40 million, our market cap is only 10 million. Why isn't it worth 40? And the answer is because either you haven't publicized what you're doing well enough, which is possible, or it's just not worth that much at this time. And you might say, well, we've got this massive chalk resource, and it's like a gazillion tons of gold in the ground. It's like, well, okay, have you done any metallurgical studies? It's a feasibility study. If you want to get it out of the ground, is it not the case you have to build a 400-mile road to the nearest city? You know, there's all sorts of things where what you might think a market cap should be valued at versus what it is very different. And if you want your market cap to reflect what you think it's worth, you need to just advance the business case, and you need to, I think for a lot of companies, just engage in PR a little bit as well. I often think, I mean, there are businesses out there that just do not talk to their investors at all whatsoever, and then they do one interview and then the share price goes up 30% and it stays up because they just want to feel listened to and heard. And it goes back to what I was saying about management and access to management. If you have an investment case that you think is really strong and is going to do really well, then you need to shout about it a bit. And you also need to be able to deal with the pushback, right? You know, if you can't engage in an interview where an interviewer asks you some fairly difficult questions, then you need to understand that nobody wants to invest in your business because they have those same questions. And the only difference is that you haven't answered them for them. So yeah, that's my philosophy.
No, that is all very valid points. You know, particularly about the you know, asking the difficult questions that most investors would love to ask, and you know, if you don't address it, then perhaps they're going to be more reluctant to get involved in that particular company. Do you look at stocks? I mean, you talked about natural resources and you talked about biotech, but do you look at investments outside those sectors?
Yeah, I mean, I you know, with IG, and then just in general, I do a significant amount of research into, you know, growth or even blue chip companies. And for example, I mean, Rolls-Royce, which I called right at the bottom, and it was kind of a little bit luck within you know, it could have been within a few weeks, but Rolls-Royce, you know, right at that pandemic bottom, and it just went up and up and up and up and up. Because one thing that I identified there, but I found it amazed me that no City analysts seem to have identified it, was that everyone was panicking about their massive debt position and the fact that no planes were flying, right? But so this was obviously back in 2020, none of their long-term debt was due to mature until 2027. So there was a huge window for the pandemic to be over, for flying to recover, for everything to be completely fine. And, you know, that more than anything else is what led the recovery. Obviously, you know, Turbo Guy comes in and turbocharges the stock as well. But, you know, a lot of it is just, you know, even with the blue chips, it is amazing to me. There's a lot of analysis that you can do that simply isn't being done by the larger companies, by the broker. And I think a big part of this is, it's this, I'm trying to make up the words. Like, say you cover Tesla, for example, and everyone's got a price target within sort of $10 of each other. It's very easy to state that same price target and use this similar kind of reasoning to reach that price target. If you're somebody that is contrarian and goes higher or lower on any stock, then your reward if you're right is fairly limited, but your risk if you're wrong is, oh, look at that idiot who didn't agree with everybody else. So it is often the case that, you know, as an individual investor, you can do a lot better. It's easier in the small cap world because there is just zero real research down here, other than the broker notes. But even in the blue chips, in the larger companies, there is so much you can do. And I would argue actually that the space that needs the most analysis and has the least support is the mid caps, right? It's the FTSE 250 companies. It's the ones that have market caps of, you know, 2 or 3 or 4 billion. They're not the giant ones that are going to hit the headlines every 5 minutes, and not the small caps that people are going to put most of their own research or time into. But there's a lot of growth companies in the FTSE 250 that will be worth 3 or 4 or 5 times what they are 2 or 3 years from now, relatively low risk comparatively. And that they you know, and that's also where I focus a lot of my time as well. But it does tend to be the case that, you know, I can write articles in these companies and people just don't read them, because what they want really is they want to invest a lot of their money into the blue chips, which feel safe, but really aren't at the valuations we're at, in my view. And it's the small caps that could do a 10, 20, 30x return from them. I find it quite funny that the companies that could, you know, 3x their money in the space of a couple of years, which is a fantastic return, people just don't seem to be that interested in them anymore. I mean, would you agree with that, Graeme? It seems to be that way to me, but I might be wrong.
We want blood and thunder, don't we?
Yeah, we like blood and thunder. But you know, with the mid caps, I mean, they're almost like the void could be covered if they had their companies listed on, you know, dual listed on the Nasdaq or something like that, because that's an area I think they could probably thrive in.
Yeah. Well, I think the if you compare, even I know the FTSE 100 is closing on 11,000 points, but even now the valuations. I mean, I'm talking about fundamental valuations, right? If you look at like the revenue and the profits and the profit margins of major FTSE 100, FTSE 250 companies, and you compare them to things on the Nasdaq at similar valuations, the UK is still horrendously cheap, comparatively.
Yeah.
So if you got that international, but then the problem is, right, is that you can go do that dual listing and you don't get any liquidity because people aren't paying attention to it. But I mean, what I find quite interesting down here in the small cap space is the OTC listings, right? Because companies will do an OTC listing, and they'll see no liquidity for a very long time and think it's a waste of time, and then something will come along, like a Chinese tungsten export ban, or like a Bitcoin treasury model, or something along those lines, and then suddenly the volume will just explode. But if you don't have that OTC listing in the first place, then the moment will pass you by. And I think it's the same if the mid caps were to pursue US listings. Initially, there'd be no volume, but then at some point, a fund manager will go, "Hang on, look at the valuations here. This is easy money to be made."
And you have to invest your time into that US listing. You can't just expect it to go up organically. It has to.
No,
you have to work it.
Yeah, well, I think one thing I think is quite funny is that the OTC itself, obviously it offers I would argue, very cheap way to gain access to American exposure, but they could quite easily build their own platform, do a lot more marketing for companies coming on, but they don't, and I think this is sort of the problem is you say, okay, right, we're going to list so you can, an investor in California can get access to our, whatever tech company in London. Why would they pick that tech company in London when they can pick 1,000 in California? And the answer is you need to shout about it and explain the valuation mismatch.
If we look at the literally billions of pounds in ISAs in the UK, what percentage, and you might know some information on this from IG, what percentage of that money is invested in US stocks, right? Because the reality of the situation is, if only a small part of that money came back and invested in the UK, what would happen to all of the stocks? Because as you say, the UK market across the world now is being looked at as incredibly cheap, on any level that you want to put it at. I mean, the small caps that we've got that are valued at £5-10 million, if they were in the US, they would be £50 million for the same asset, for the same opportunity. Bazant is a good example. Extract Resources is a good example. AJAX is a good example. GMET was a good example, and then obviously has increased. What do you think, Charles? And after we've done that, what I'm going to do is, so we make it slightly stock specific, we're going to go through the 12 stocks that we picked at the end of last year, myself and Graham, and see what you thought.
Yeah, so I think the most recent stat is 38% allocation towards US stocks within ISAs. However, you've got to bear in mind that most people are investing in cash ISAs and not stocks and shares in the first place. So there's a huge amount of capital that could be rotated towards the UK. One of the problems is, I mean, the government has talked about, well, they already are restricting cash ISAs to a degree. They've talked about trying to get US stocks to people to invest less in the US and more in the UK. But there's a few problems there. So, like, one of the first problems is, you invest in ISA for your own personal wealth growth. If the UK doesn't generate the growth that you're hoping for, then you're going to stick with the US. The second problem is that a lot of people investing in ISAs are not stock picking. They're going for world index funds, right? And they feel like it's like global tracking, but actually most world index funds, 60% of their allocation goes toward the US, predominantly in tech stocks, simply because of how dominant those market capitalizations are. But the third problem is, and I think it's probably more important, is the fiddling with the tax system. So, for example, it used to be the case that our equities markets were propped up by pension funds in the UK. And then what happened was successive chancellors fiddled with it. And the biggest difference was it used to be the case that UK stocks in UK pension funds could pay out dividends tax-free. This is basically how the system always was. And then it changed and it changed and it changed. and obviously governments love getting more and more money, but the problem is that as they tax the dividends more and more, the pension funds realize, because they're not there to take on risks, they're there to make sure those pensions can get paid out. They went, well, we'll go to the US for growth, because capital growth, if the capital growth is going to be charged the same as dividends, we might as well go for the growth in the US and forget the dividends, which are all the FTSE 100 stocks. And then for safety, we'll go to bonds. And so, and that has transferred into the UK. And I find it kind of fascinating almost that, people don't particularly invest in the UK because they just like what they perceive as a risk. Well, and a lot of it is around the regulatory language that I have to use at IG. And I'm sure no one at IG would be unhappy with me saying this, but all of the language that you're required to use around like stock investing, you have to explain the risks. You have to say you might lose your money. You put 10 grand in, you might not get 10 grand back out, etc., etc. But if you invest 10 grand in a cash ISA and it's paying 2% interest and inflation is 3%, then you're going to lose money guaranteed every year. But that's not allowed to be expanded on. And I think probably taking aim at a particular government product that kind of destroys the UK investing mindset, in my mind, is premium bonds. I think when people think investing in the UK, they think what we'll do, we'll put it into premium bonds, and then there's a chance I'll be a millionaire, but my money is quote unquote safe, and I'll probably win a few small prizes. And they say win, that language itself is really awful. If you were a private company, you wouldn't be allowed to use it, would you? You wouldn't be, if you were IG or Hargreaves, you wouldn't be allowed to say, oh, you're going to win. No, what we're going to do is we're going to collect all of the interest from this money you've deposited, and we're going to keep some of it, and you're going to get less of it back, and then 1 or 2 people are going to be millionaires. Probably people with 50 grand in or 60 grand or whatever the limit is. But if you were to scrap premium bonds, for example, and say, we're not doing premium bonds anymore, they're a waste of time, they're really bad for the government, for investing, for saving, we're going to replace it with a UK equities index tracker that you invest in through NS&I, and you can invest, kind of like an ISA. If those billions and billions and billions of pounds went into the equities market instead, everyone investing would be significantly richer, and then the investing mindset would start from a young age. And I think the key point is, for me, is the concept of risk. People don't understand that once you've earned your money and paid your tax on it, whatever you do with it is a risk. You put it in a savings account, okay, the government says inflation is 3%. Are you actually going to keep up with the rising cost of food? Probably not. You look at the housing market and you think how high housing prices are going again and again and again. The savings account is not going to help you. You put it into investing, then even if you put it S&P 500, then you're going to double your money roughly every 7 years. And obviously you can have a very bad period and be unlucky, but as a general rule that has held true because the US likes to print money. And if you put it into small caps, there's a good chance you'll lose money on some of them, but there are others that might be life-changing. And that's basically what, my perspective on it. I think we just need to have a significantly better heightened attitude towards risk in the UK.
Okay, so let's go into our 12 stocks that we picked last year. The first one with so far the worst performance, this was Friday close now, 0.98p, was WCAP, down 51%. What's your thoughts, Graham and Charles?
So WCAP is an investment company. It's listed on Aquis. It has, I think, an 11.8% stake in WeShop. WeShop, their shares had a fantastic debut. I think they debuted in November at $20 a share. They went as high as $250 a share. And that's where WeCap itself got caught up in that. And the stock went from, I think, about a penny to, I think it almost hit intraday, I think, at 4 pence a share. But since then, it's fallen down, not so much on the back of WeShop, or partially on the back of WeShop, but also about this sort of, uncertainty regarding its discounted loan notes that it had with its major or principal loan note provider, which is Hawk Investments. That has now been addressed. So originally, that was due for repayment in May this year. That's now been extended until May 2027. Slight expense in that they're going to add an extra £1 million in the repayment. So it's going to go from 7 million to 8 million pounds to be repaid. And they've also had to issue 20 million warrants at 1.5p a share, which is roughly double what the current share price at the moment. But I personally think that WCAP's in a great position now, and really just focused on the fortunes of WeShop. So as long as WeShop perform, then WeCap will probably get dragged up along with it. And today it was just unfortunate. On Friday, WeShop had fell quite a lot after they announced the restructuring of the deal. That WeShop fell into the close on Friday, and WeCap have kind of followed suit. So I think that's where we are. That's my sort of understanding of it.
Yeah, I think the WeShop shares are locked in until November, right?
Yes.
So the share price is going to bounce up and down until we get there. I think that £7 million debt effectively must be repaid before the shareholders can access that value. So it's almost like there's a gate, almost, where you're going to need to get hold of that capital to repay it. But then once you get those WeShop shares, assuming all is going according to plan, the upside could be tremendous. And where I think there's a problem, potentially, maybe that's not the right word, is that in the small cap world, people's attention spans are very low. But also, not only do people know that, you're laughing, but everybody knows that, you know? So it's a self-fulfilling prophecy. So you might find that when it comes to sort of October time, the interest surges again, right? So
Yeah.
you know, if I were approaching it, I would say, well, keep it on the watch list. And if the share price gets to a point where it looks extraordinarily good value, buy some shares, wait till November, and you might find that you do extraordinarily well.
Alternatively, build a bloody big position, because the odds are it's probably going to make lots of money towards the end of the year. I mean, my view on it is the crossover price, if you like, at $20 WeShop is about 4p, okay, for WeCap, and it's currently less than a penny. So you're looking at 4 times now the debt, and that includes the debt being repaid. The debt now has been pushed back to May of 2027, so there's going to be a 6-month period there where they're going to be able to edge out if they need to. The long-term view was that WeCap would hold these shares, not even after November. It's not. I don't think it's going to be a sell and get out. So the whole premise is: do you believe in WeShop? If you believe in WeShop, then it's a buy, and it's now on 50% discount from what it was when we recommended it.
Yeah, no, I was going to say, I think that the key thing is, again, it's this kind of UK versus US capital argument, right? Like it's, you know, having spent a lot of time in New York over the past 2 or 3 years, in the UK, people always like, what could go wrong? What are the risks? This is really risky and we don't like it. And in the US, the attitude is, this is really risky. I love it. I love this risk. We're going to go for it. And I think that's you know, when you look at WeShop, you know, it might be unprofitable. It might be valued at a significant premium to its assets, but the potential returns, that's what US investors care about and are focused on, versus in the UK, the risk profile. So we shall see. But yeah, I think when it comes to November, we'll see a big bump.
I also think that in America they are. I mean, I've got cousins in America. They've all got accounts with Bank of America. They're just ordinary, you know, people, pharmacists and whatever. They're just, but they love investing in the market. It's not over yet. My cousins, they don't know about them.
We obviously, our ISA is still, you know, that 20 grand ISA allowance is still fantastic by international. There's nothing quite like it by international standards, where you get the tax advantages, but also the liquidity and the ability to withdraw in or out whenever you like. In the US, if you're not from the US, you won't know this, but you can deduct $3,000 of capital losses off your income tax from your income. So the incentive to invest in high risk assets there, to the tune of $3,000, individually, it's not particularly much money, but across tens or hundreds of millions of investors, you put $3,000 in and you lose it. You haven't actually lost it. You just would take it off your income tax.
I didn't know.
No. So any decent accountant over there will do that for you. Obviously, that's across your portfolio as a whole. But it does mean those small retail investors are highly incentivized to go for high risk companies at growth profile. And our what we have over here, which is kind of similar, is SEIS, or, you know, enterprise investment schemes. But I would argue that's very difficult for the average retail investor to access. Whereas in the US, it's not at all, and it's in public markets.
Yeah.
Yeah.
I think We Shop's model will play into, they've listed on the perfect exchange, the NASDAQ, because We Shop it's all about giving a percentage of the business over to the consumer. And I think that will, it's almost self-serving, because anyone who's actually got an interest in the stock market and all of a sudden starts buying products on the We Shop platform and actually sees, them getting a reward, and then potentially they could end up, it's almost like free advertising.
It's the staking model in cryptocurrency, right? Like if you take like Ethereum or Crow or whatever and stake it, you'll generate more for yourself while also improving the platform. So it's very, very similar, and it does make a lot of sense, and it will appeal to Americans.
Okay, so the next one, which hasn't done so well so far, is Haydale. Do you want to? But I hasten to say both of these were yours, Graham. down 17%.
Well, I've got no problem with this, and I've actually got a friend of mine who's so just to Haydale own a subsidiary called Just Heat, right? Which basically has this underfloor heating that is powered by graphene. So imagine having like a duct tape that you take to the bottom of your floorboards, right? Instead of having a pipe that goes sort of twirling around under your floor, you've got this graphene that you can literally switch on and off with a light switch, and it's a fraction of what you would pay with normal heating. He said it's unbelievable how it works. Even his builder said he actually installed it. He said, I don't believe this is going to work. He's installed it, and he said it's I think it's changed the way he thinks. So I think this is just a question of time before it catches on. But they've also got this subsidiary, or they've just merged with another business to do with carbon credits. There's some announcement today about the rollout of that. That bit I don't understand so much. I'm more focused on the Just Heat graphene side, which I think is going to really help them.
Okay, so you're still confident?
I'm still really bullish about Haydale.
Okay,
I've not changed.
Let's move on quickly. The next one, Charles, Solvanus Therapeutics is flat. What do you think?
Yeah, I think that with Solvanus, obviously, it seems to be the case that it's actually kind of rare. You very clearly got one or two very big sellers and also one or two very big buyers. And, in this case, it really frustrates me because this is not a Solvanus specific situation. But if you have a lot of shares in a stock that you want to offload and there's someone who wants to buy them from you, for the love of God, just call your broker and just say, look, I want to offload these shares. And this is what your broker, the reason why your broker charges you a fee is they'll then go out to the other brokers in the world and say, look, we want to offload a load of shares. Let's agree on off-market price and just get this done. I don't understand. It seems to be kind of mad. That used to be the way it always used to work, right? And now it seems to be that people kind of just dump the shares on the market and they get a worse price than if they had agreed one in the first place. On the fundamental side, those phase 3 clinical trials are they will become the standard of care in what they're treating. I'm certain of it. And so it's I say certain, things can go wrong. A lot of the work is being done a mile from my house at the University of Exeter, my alma mater. This is a very easy hold, or even actually, I'll say actually I've been averaging down over the past couple of months. So sit tight and just wait for the results to show themselves. Simple as that for me. Right?
Yeah, agreed. Okay, the next one, which is also, which is the first one that's up, it's about up just over 12%, is AJAX Resources.
Yeah, so I think we've covered the CEO and the management. The assets there are very simple. What they're looking to acquire, but I think most importantly, talk about the one that they already have, which is the gold resource. That, if it's developed, which is being drilled, and we get the assays back, and they are what we hope they're going to be, it's going to re-rate hard. It's as simple as that, really. It's up slightly because the eyeballs are not on it yet. The general investor consciousness is not focused on it, but it will be in the near future. I think a year from now, it'll do very, very well. But a lot of it there's a lot of news coming, and that's public information. that we're just waiting for, basically, and we've been waiting a while. So
Yeah, I had messages with Ippolito actually as we were recording this podcast. He's back in I think Argentina. News today that they've signed the Leon deal. So the Leon deal is now not going to be called Leon; it's going to be called something else. Excuse my ignorance and not remembering what the name was. And that Leon
It was
project
named
actually.
an Argentine heroine,
That's right. Yeah.
apparently.
I think it's going to rocket, and in the not too distant future. I think there are lots of catalysts there. I think for a market cap of in and around £8 million, £8-9 million, the assets they've got are fantastic. So yeah. Okay, the next one then we'll give this one to you, Graeme, because I think you chose it. Was Upland Resources.
Uplands is really really interesting. They've done a deal with this company called Lost Soldier, run by a guy called Mark Bruner. Mark Bruner was behind Ultra Petroleum, went from 8 cents to $200 at one stage. Lost Soldier have got this joint sort of mutual investment in each other. So the Uplands have got an investment into Lost Soldier. Lost Soldier have got investment into Uplands, or something like that. And now they've just won these MOUs in Sumatra. I think they're talking about going up to about 20,000 barrels of oil per day, or the equivalent of in gas terms as well. But that's an MOU at the moment. We'll have to see if that turns into an actual production sharing contract. They haven't discussed what the terms are going to be. Going in the right direction, so I'm happy.
Very good. Next one, Bazant Resources. We'll give that one to you, Charles. I mean, gold at 5.4 and copper at probably close to 14,000 now. How does that look?
Yeah, so I mean, when I initially did the figures on Bazant 2 or 3 years ago, you were looking at an operation that was going to generate, I think it was sort of like $8, $9, $10 million in profit. But the thing is that with the commodity prices going up, your OPEX costs have gone up a little bit from inflation, but the profit margins are just going absolutely mental. And I think the problem is now almost with this stock is that if it does work as intended, not only the production but also the potential exploration, because the profits look so ridiculous compared to the market cap, people don't believe it's going to happen. It's as simple as that, really. And yes, there is operational and execution risk, and you actually have to get up and building and cracking. But the idea is to have copper and gold production before the end, a long time before the end of this year. And the first month, because it'll be sold, the concentrates will be sold to Chinese parties at the gate. So the first month that copper and gold gets collected and paid for, it'll re-rate instantly. But until that point, it'll find it difficult, I think, because it's just difficult to believe what the profit margins are.
Yeah, Martin Churchhouse and Colin Bird both scratching the head in terms of that market cap. Doesn't make any sense at this moment in time.
Well, but this thing, Cav, right? If I said to you, I've got a market opportunity that it might double in the next 6 months, you'd probably go, oh, that's reasonable. If I said it might 10x in the next 6 months, you'd probably go, that seems unlikely. So yeah, we shall see.
I think somewhere between those two figures is what will happen. Okay, next one, Jubilee Metals.
Yeah, so Jubilee is that's a simple one for me. I mean, I averaged down significantly, as I told you last year. I think that it's just a fundamental story, right? Like, you have $90 million coming in, a lot of it's already in, versus the market capitalization. Basically, we're at a point where the cash in or coming into the company plus Rowan justifies the market cap. Then you have the platinum asset still in South Africa. You have Sable. You have Molefe. You have the large waste rock project, all of which could be company makers or are company makers. And it just has to re-rate. I think basically one of the problems that Jubilee had, there's two problems. The first is that it's had delays in getting to where it needed to be historically. And there's no shying away from that. But you also had a situation where a couple of funds last year were selling. They needed cash fast, basically. This isn't a secret. This is quite easy to find out. They needed cash fast, and the only thing that was one of the few things that was liquid in their portfolio was Jubilee. So they sold Jubilee shares at whatever price to get the cash that they wanted. Now those funds are out. The share price is rising. Copper's going ridiculously high, and there's tens of millions in cash in the bank. The only thing I would say, and I actually have said to Leon, the CEO there, is that he needs to diversify out of Zambia, because that single jurisdictional risk isn't worth having when you've got the cash to invest elsewhere as well.
Yeah, agreed.
So yeah, it's going to do well.
Okay, and having just visited the mine there close to Sable, that is going to be a company maker on its own. I think that could become a tier 1 asset. They're looking at all of the land all around of it, and there's copper galore there. But anyway, okay, the next one. Try and say this in one sentence. Greatland Resources.
Greatland Resources. Okay. So my wife and I actually put a significant amount of capital into this company when it was at 5p, a pound in old money, and it's now trading around 7, right? I always thought,
£7.55. It's £7.55. It's up 44%.
Okay. Well, I mean, I always thought it was a quote unquote steal back at that price, and I still don't understand how Greatland acquired the farm for the price that it achieved. I still don't get it, and obviously the gold price rocketing has helped significantly. I think it's going to go higher. This is the thing with it. I think I stopped covering it myself in Substack because it's got to a point where the market capitalization is just beyond what I usually cover. But the West Dome is a game changer, but also the fact that you have so much cash, you can now, if you chose to develop Havieron without any debt, and Havieron is a real prize, because if you're doing an all-in sustaining cost under $1,000, when gold by that point could be $7,000 or $8,000, then you can see how it becomes attractive. And even now, if you compare Greatland to Genesis or its peers on the ASX, it's still horrendously undervalued. I would say though that actually the most exciting part about the whole investment case, if you were to think about it, is the management that are on board are there for multiples even of where we are now, and B, kind of like Amarok in Greenland, these guys, they own the farm, they own the mill, they own Telfer. So all of those, there's a few explorers out, listed in London, which I'm not going to name because, but there's dozens on the ASX as well, who are all drilling, looking for another tier 1 deposit. And if they find a tier 1 deposit, collectively, those tens of millions of dollars, they will find one because there's more to be found out there. Where is it going to get processed? It's the same with Antipa and Minyari, right? It's going to go to Telfer eventually.
That was the longest one line. I knew I shouldn't have said one line. It was it was like
no, Kev. I'll tell you.
Ask Charles a one-line question about Greatland Resources, and we're here till tomorrow.
But... Well, I didn't brief, did I? So, but I think the key thing is no, you because I did the research, and it was obvious what was going to happen to me, where the share price was going to go, and yeah, it seemed that people were like all just focused on the risks and not the potential rewards, which were just and I will say things can and do go wrong, but in that particular instance, it was just madness, just utter madness. So anyway, nice to see it continuing to rise.
Let's move on. It's 44% up since we picked it, 53% up since we picked it. Energy Pathways, Graeme, you are the Energy Pathways man. Go.
Well, I mean, we had the placing at 6p. It went almost straight away to a discount down to 4p. I think there was this sort of still like reticence, I think, from the investors' point of view, that they thought that they could never really get it away. And then, of course, out of the blue, the Section 35 got approved. And I think that's really helped put Energy Pathways on the map. And it's gone to a premium to the placing price. I think it peaked at 7.5p not that long ago. It's now just above 6p, probably on the back of this sell-off that we're seeing. I think all eyes are on the North Sea Transition Authority. I think people are expecting that to get approved any day soon. And I think if they do, this is going to be a stop that everyone is going to be talking about. A lot of people are going to be talking about. So, yeah, that's my one-liner.
So, something I think is kind of really important is like the political risk in the UK, right? And something I quite like, well, not quite like, I very much like about Energy Pathways is that, under our current government, they issued the Section 35. So they want to get this built, how much time that takes for them to fully approve it, we shall see. If Ed Miliband takes over, as people think might happen from Keir Starmer, well, he ultimately was the man that approved the Section 35. So great. If the Greens win significant political power, so, they just won that by-election, The oil and gas issues might be a problem, but they have such green credentials, that project, comparatively, plus the gas storage, they'll be, in for a win. And if Reform gets in, then it's flexible. Reform isn't particularly impressed with green credentials, but we do need gas storage, and it fits into their plans as well. So I think one of the key problems that a lot of companies have come unstuck, like, Tungsten West, for example, when basically their OPEX doubled, when the energy cost went up in the UK, or, Harbour Energy with the North Sea problems, or the miners, looking for, lithium in Cornwall, they all got hit with political issues. But with this particular one, it's so flexible and so valuable across different value chains that it's politically easy to approve no matter what brand of tie someone's wearing. And I think that's also super important. I wanted to mention it.
Okay, the next one, Extract Resources. I'm going to take Extract Resources. Extract Resources is going to be producing copper, gold, silver in Silver King in Zambia within the next month. On top of that, the antimony in Morocco, which is going to be producing significant amounts of antimony, probably by the end of 2027, if not before. That will be a game changer. When I've done the maths on that, that is absolutely massive in terms of the amount of potential free cash flow that will kick off. On top of that, you've then got Bush Ranger, which 1.3 million tons of contained copper in Australia, profitable over $10,000 of a copper price. It's now closing in on $14,000. What's not to like? It's worth about 11 million, 12 million pounds, and it's stupid price. And it's already up 69% since I did it, but I think it's only just begun. Okay, that's the end of mine. Guardian Metal Resources is the next one, up 92% since we picked it. Do you want to go for that, Charles?
Yeah, sure, no problem. It's very simple, this one. China is basically making it impossible to get hold of tungsten. China processes all of the tungsten. China has control of all of the tungsten, pretty much in the world. And so you're seeing tungsten prices just go through the roof. And by through the roof, I mean like 10% rises a day. It's just ridiculous. The United States of America has no domestic tungsten production. Guardian Metal has the two largest tungsten assets in the country. They're both very close to each other. That's Pilot Mountain and Tempaiut. They already have government grant funding. And obviously, if you were invested from the 7.5T days, as I and my wife were, you've done extraordinarily well. Now, one of the key things is, when it was up sort of 10, 15x, people said, it won't go higher. And we did toy with selling because we made a lot of money off it, but ultimately we didn't, because, again, we go back to that same story. It's US capital. That US listing, US money is different to UK money. US risk appetite is different to UK risk appetite. That US listing comes along, and then suddenly you get a significant amount of capital going into it. And you already are, it's no secret Oliver's over there having dozens of meetings with various funds and very senior people. This asset, I think my end game for this is that it will get sold out by the end of the year to a larger company post US listing. It's as simple as that, really. And that's basically where we are.
I think it's got £8 to £10 in it, based on the current valuation. I think it's going to be worth over £1 million British pounds, and that's one of the reasons why I chose it, because of the US side of things. Okay, currently up 92%. The winner, Chicken Dinner, as we speak, is up 300% at 0.67 or 68p, is Delta Gold Technologies, the blue sky quantum computing. They've signed up Toronto University, now Penn State in the US. It looks like we're going to get some IP from Penn State in the not too distant. And they're also progressing with UK universities, which we'll hopefully see over the next few months. Announcement today, just basically saying they've paid forward for Toronto for next year already, so that Toronto can move forward on some sort of cold storage that they require for the quantum. It's blue sky, and the reality of the situation is it's still only worth 35-40 million pounds. In the grand scheme of tech companies, that would be a rounding error. And if they want this IP, they're going to pay for it. Any thoughts, gentlemen?
I think that when it initially listed, It was just the investment case was you would have basically they were invested in one university doing one project, and then even though one university doing one project, if it doesn't crack this particular aspect of quantum computing, it could create a level of research which a larger company would be interested in. So it's a good bet, but it is still a binary bet. Now that it's expanding into more than one university and potentially multiple universities across potentially the world, and again, big potential and big, blue sky hopes, that distributed quantum research model is significantly less risky, in my mind, than just being invested in a single project at one university, no matter how good the lab is. So I think your risk profile has gone down, even though the market cap has gone up. Graeme?
Yeah.
Just more from a generalistic point of view, I think if I'm right in saying this, that a lot of stock is held with EIS and SEIS investors, and if they want to take advantage from a tax point of view, if you're a UK resident and you want to have benefit, that you need to hold this for 3 years. If you have this lovely tightness of supply of stock, but at the same time you have this this continual demand coming through, and I think that's only benefiting the share price.
Yeah, and I think I'd imagine it's a knowledge-intensive EIS/SEIS opportunity as well. So there's further ties there that you're very much incentivized not to sell for those 3 years, even more so than the standard EIS investment.
Yeah. I don't know whether it was knowledge. I think they've applied for that, but I don't know whether it was. But you're right. The stock is very, very tightly held, and there are institutions and different things who want it in. Institution just came in at 35p, literally less than 2 weeks ago, and we're already close to the warrant accelerator at 70p. So that will give them more cash again. This is almost like a GMET story, isn't it? When you think about it, GMET, they raised, they put a warrant on it, then the warrant had an accelerator, and then that accelerator got triggered, more money came into the company, the story kept getting better, and it's just a snowball.
Well, I think you look at the investor base behind them.
Yeah, 300% up.
What's the overall percentage?
We're up. It doesn't calculate it exactly because the Delta Gold price and the AJAX hasn't updated, but if we do it, it's about 50%. Year to date. So from December the 18th to now, we are up 50% on average per stock.
Do you know what, gents? I think that's it. Sell everything, call it a day. Fantastic. We've beaten everyone. Come back next year.
It was in January. Was it January? We just when we
picked them, I think, between Christmas and the New Year, and it went out in January.
Yeah.
So Delta Gold was 17p, Guardian was £1.48. Extract was 0.65, Energy Pathways was 4.05, Greatland was 525, Jubilee was 303, Besant was 008, Uplands was 2.8, AJAX was 7.12, Solvanus was 2.25, Haydale was 0.485, WCAP was 2p. I think we have a very good balanced portfolio there. If you are risk on and looking at the resource space, which is obviously what we have been doing, though we want on MUMS to be more tech orientated, and that is something that hopefully you'll see from us over the next year, that we're looking for tech stocks that can perform. Okay, Charles, we'll ask you, what is your favorite meal, or the meal that you would have if it was the last one that you had on Earth?
That's easy. That's fish and chips from this fish and chip shop in Exmouth called Crispies, and they batter the chips before they fry them, and the fish comes in straight from the boat. And I'll tell you why. Because this, like, if you have a Sunday roast, right, especially if you get someone else to cook it, often it's quite easy to foul something up, like the potatoes or the Yorkshires or the chicken. Something will go wrong. A curry is always good, but the very best curry can't beat fish and chips. I think a decent fish and chips that's hot, that's cooked properly, cannot be beaten, especially on a cold day at the beach.
What about curry and chips, Charles?
Of course, as much salt and vinegar as possible, and then exercise it off.
Mushy peas?
No peas, just fish and chips. You don't want to put greenery. Like, you're not trying to be healthy. It's like when you go to McDonald's. Like, I took my children to McDonald's yesterday because it was the convenient option and they like it. And it asked, with the Happy Meal, do they want a fruit bag? It's like, who goes to McDonald's for fruit? Who goes to a fish and chip shop for mushy peas? This is ridiculous. No.
I have to have mushy peas. Mushy peas and curry sauce is a given.
Well, it's I'm trying to think of the word. It's like I don't drink much like fizzy drinks, right? Like I really don't, because they took all the sugar out of them. And pretty much the only thing I drink now is Coca-Cola, and I don't have very much of it. But it's this kind of mental world now where like people kind of want to punish them. Like if you want to have like a meal which is a bit fatty or a bit carbohydrate and not particularly healthy, just actually enjoy it and stop trying to put vegetables in it. Because the point is you're not meant to eat it every day. I think this is where people go wrong. They go, right, well, we're going to have takeaway every day. And if we have vegetables with our, a buttered, full fat, bloody, buttered chicken, and we do that 7 days a week, that's somehow healthy. No. Madness.
Okay.
But anyway, I'm very opinionated on many things.
The last question that we will ask you is, what's the best advice you've both given and received in your life?
The best advice I've ever been given was from my father, who's been married to my mother for 45 years. And I'm one of 12 children, believe it or not. I'm the third eldest. And his only advice to me, and this is funny because he's actually a independent financial advisor, was to marry the right person, which I did. And that's actually quite deep on a different number of levels, but obviously your emotional happiness, but also probably the most important financial decision you're going to make as well. In terms of the best advice I've ever given, it would probably be diversification. I would say is probably the most important one. I would say particularly when you're talking about investing, and I don't give personalized advice, I'd say that ensuring that you have a portfolio which can stand up to scrutiny when you're stressed about it falling is the most important thing. But yes, I'd say the advice my father gave me is more important than any advice I've given anyone else. And I'd advise anyone thinking about finance to think about the consequences, particularly legal, of marrying the wrong person, which I have seen more than one time.
Have you been giving financial advice to your father now?
I don't give financial. No. He's horrendously successful, all by himself, doing in different areas. But I don't know. We do chat from time to time, but I think my portfolio would give him a heart attack, so I'd rather keep him alive.
Okay. Very good. Thank you very much for tuning in. Don't forget, if you like what you see, please like and subscribe. And remember, mum's the word.
This podcast was brought to you by Monday Upbeat Markets. If you would like to appear on a future episode of the MUMS podcast, please email mondayupbeatmarkets@gmail.com.